could everybody turn to page 3.1 for a moment? That's City Cycle's balance sheet. We addressed that briefly yesterday. And I want you to notice the property, plant, and equipment section, also known as fixed assets. Let's go through the four characteristics one more time. What's the first? It's tangible, okay? What's the second? Not inventory. In other words, we're not going to use it to resell. We didn't buy it to resell. We bought it to use it, okay? So it's not inventory. Third one. Material and value, so it's more expensive. Now, one of the reasons why materiality is so important is because we're going to depreciate this asset. It's going to take time. And this little $35 laser pen, if we had to depreciate that, that would take a lot of extra time. It's just not worth that extra effort. So we have materialities. And what's the fourth one? Expected life, and more than 1 year. Again, if we were going to use up its entire value in the next 12 months, then we wouldn't be depreciating. We wouldn't need to worry about depreciating. Okay, so there's all good reasons why we do this. If you'll look at City Cycle's balance sheet, you'll notice the different fixed assets, beginning with furniture and fixtures, and to the right of that shows the original cost of those furniture and fixtures. And the original cost of them is how much? $2,479. Now, we might have had that furniture for 2 or 3 or 4 years already, but it cost us $2,479. Is it still worth $2,479? No. Absolutely not. Okay? It goes down in value, doesn't it? And the term we use is depreciates in value. But we're going to leave it on its original cost until we physically dispose of that furniture and fixtures. We have to get rid of it. It has to be outside of our control. We can't just take it back and throw it in a junk heap in the back of the building, okay? And then write it off. It's still in our control. It has to be physically removed and taken out and given to the landfill or given to somebody else or sold to somebody. Has to be gone. Now, recognizing the count number 284 is furniture and fixtures, I want you to look at the accrual section of the general ledger and the balance sheet, and you'll see that the first account in there is account 384, accumulated depreciation furniture and fixtures. Do you see that? Those two accounts are linked. They're tied together. They relate to one another. And so the balance of $2,479.23 is the original cost, and the depreciation on that same balance is $413.20. There is a term that we use, and it's called book value when we subtract the one from the other. If we take the original cost of $2,479 and we subtract the accumulated depreciation, which is $413 in this case, we're going to come to the book value. And in this case, it's $2,066. Okay? Now, that $2,066, you don't see that on the balance sheet. It's a calculated number. But that $413 applies to the $2,479. They're tied together. So then let's look at the next one. We have service vehicles. That's the company car, company truck. And it originally cost us $6,918. And so far to date, we have depreciated that company truck $830. So calculate for me the book value. Tell me what the book value is on that. Good. $6,088. Okay? Okay. And notice again that leasehold improvements is tied to accumulated amortization leasehold improvements. Calculate the book value there. How much did you get, Dixie? $977.37. Anybody else getting that? Okay. Now, for every fixed asset account, there will be an associated accumulated depreciation account. There's only one exception to that, and that's land. Anyone know why we do not have accumulated depreciation account for land? Taylor?
Land normally doesn't depreciate.
Land doesn't depreciate. That's right. So we don't have it. Land typically appreciates, so we don't depreciate it to make the difference even worse. Let me tell you this, that this depreciation number here, our purpose, where does this, first of all, where does the original cost come from? Where do we get that number from? Yeah, whatever we paid for it, the invoice, okay? But this number is a calculated number, using a systematic method of coming up with it. And we as accountants are the ones that do this number. And our purpose is to increase this number. As we increase this number, what happens to the book value? It reduces. It goes down, right? Now, over its life expectancy, we're going to increase this number until this accumulated depreciation account equals the original cost. At that point, what will be book value? Zero. So our books, when you compare the original cost to the accumulated depreciation, will say the book value is zero. It has no value on the books. So then do we take it off the books?
No.
What must happen before we take it off the books? We got to get rid of it. So if we have this furniture, the same furniture, for the next 20 years, certainly by then, we will have fully depreciated it. The book value will be zero. Even after 20 years, the furniture is still going to show at $2,479, right? And accumulated depreciation will still be $2,479 until we throw it away or give it away, or after 20 years, it's going to be dust on the ground anyway. So book value does not necessarily represent market value, okay? Book value is simply a calculated number. Market value is a perceived negotiated number. You see that? Okay.